Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be analyzing if Dutch Bros stock is a buy. Dutch Bros, stock ticker symbol BROS, is just one of many companies we explore on this channel. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Dutch Bros. Dutch Bros was founded in 1992 by the Boersma brothers in Grants Pass, Oregon as an excitement for the taste buds and to disrupt a well-known behemoth incumbent. The founders envisioned an efficient shop for high-quality, customizable coffee and genuine connection, serving up rebel energy drinks, nitro cold brews, and blended creations like Shark Bite and Annihilator. The company caters to every caffeine craving. In 2021, the drive-thru only coffee chain went public, joining the stock market scene. Their shares skyrocketed on the first day, proving their loyal fanbase translated into investor love. Today Dutch Bros boasts over 790 locations across 16 states, fueled by a dedicated team of more than 23,000 employees. Now let's look at the price action. Starting with the 1-year chart, we see that Dutch Bros had a CAGR of about -21%. Zooming out to the 5-year chart, we see that Dutch Bros has only been public since 2021 and has had a CAGR of -11%. Dutch Bros share price has been a steady climber but has pulled back recently. If we perform a backtest comparison of investing $10,000 in Dutch Bros versus the S&P 500, we find some poor results for Dutch Bros. In that comparison with the S&P 500, $10,000 invested in Dutch Bros would have shrunk to $6,221 or a -21% CAGR versus $10,326 or a 2% CAGR if invested in the S&P 500. This demonstrates underperformance for Dutch Bros. Furthermore, a Dutch Bros investment would have been more volatile with a 52% standard deviation versus 20% for the S&P 500. Dutch Bros underperformed the S&P 500 in terms of the best year performance, for which Dutch Bros grew 12% versus S&P 500 26%, and worst year performance where Dutch Bros fell 45% versus the S&P 500 18% fall. In terms of max drawdown, Dutch Bros fell 58%, more than the max drawdown of 24% for the S&P 500. And surprisingly, Dutch Bros did underperform the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. Essentially, Dutch Bros went public near the inflationary market peak of 2021 and has ridden the sobering fall downwards since. Now let's hop over to market share and take a look at the market share for Dutch Bros. So we come over here and type in the ticker symbol for Dutch Bros and see that the market share is 0.1% out of the publicly traded food, beverage, and restaurant stocks currently in the market. This is very small market share, but the company is growing. The 5-year market share CAGR for Dutch Bros is 32%. This is excellent growth. If we start in 2019, we see that the market share was 0.04%, 0.05% in 2020, 0.06% in 2021, 0.09% in 2022, and 0.1% over the trailing 12 months. You can think of Dutch Bros market share doubling around every 3 years. In this newest version of market share, we can actually perform a sub-analysis among a basket of similar companies. For instance, if we want to compare Dutch Bros against its competition in the coffee space, Black Rifle Coffee, we find some interesting results. Out of a basket of those two companies, Dutch Bros has a 71% market share, meaning it is the larger of the two companies. However, we see that Dutch Bros market share fell at a -1% CAGR. This is not as horrible as it sounds. For one, it means that the coffee industry is growing as a whole, but 2, that Black Rifle Coffee is actually gaining market share faster than Dutch Bros. While Dutch Bros has been growing market share on an absolute basis, it is losing that battle on a relative basis when compared with Black Rifle Coffee. Let's take a look at the fundamentals. Gross margin is 27%. This is on par with other similar companies. Revenue has compounded at around 43% over the past 5 years and has reached $914 million most recently. Nice. So many lattes and mochas. Looking at cash flow, we see a 20% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 58% CAGR. As a result, free cash flow flipped negative in 2021 and has worsened since that time. The company has really ramped up capex investment as it tries to achieve 1,000 stores across the United States by 2025. Weighted average shares outstanding have risen ever since IPO, going from 45.9 million shares in 2021 to 57 million shares most recently. Dutch Bros has been leveraging equity sales to raise cash. Given the free cash flow is negative, I think Dutch Bros will continue to dilute shareholders for the near future. It may be a long time before we see share buybacks at the company. Now let's view return on invested capital. Return on invested capital has increased from -26% in 2021 to 2% in 2023. Efficiency seems to be improving, ever so slowly. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 8 days in 2020 to 13 days most recently, Dutch Bros has gotten less efficient over time. While negative cash conversion cycle values are better, 13 days is not too bad. I would like to see this value back down to single digits in the next 12 months. Now, let's look at the debt for Dutch Bros. The net debt to EBITDA has increased over the past 5 years, going from 0.8 in 2019 to 3.6 most recently. While zero debt is better than any debt, the debt level for Dutch Bros is not prohibitively high in my opinion. Hopefully this downward trend continues. The fundamentals of Dutch Bros are pretty decent. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Dutch Bros. It is a restaurant company with a gross margin of 27%. The revenue per share CAGR since IPO is 25% and the free cash flow per share CAGR is -61%. We will use these values for the 5-year data. Here we should also note that while revenue growth has been great, the company is free cash flow negative because they are spending so much on capex. On a generally accepted accounting principles basis, Dutch Bros is actually profitable, which is great news. Presumably the company could decide to reduce capex spending and run cash flow positive immediately. Because of this, the negative cash flow per share CAGR value is not that troublesome in my opinion. A return on invested capital of 2% is low but growing. Next, the cash conversion cycle of 13 days is not too bad, but I expect this value to improve soon. Concerning debt, a net debt to EBITDA of 3.6 means that it would take Dutch Bros a little over 3.5 years of earnings to pay back their debt. So from a fundamental standpoint, Dutch Bros is kinda solid. Now let's switch our attention over to valuation. Dutch Bros is significantly overvalued relative to the S&P 500 with a ratio of 27.6. The price to earnings growth, or PEG ratio, is 15.4, indicating that Dutch Bros is overvalued relative to their projected earnings growth. While Dutch Bros is clearly overvalued using these metrics, I expect their earnings to grow very quickly, which should improve the valuation for the company. Dutch Bros has had tremendous growth over the past 5 years as noted by its market share expansion. The awesome revenue growth is trickling down the income statement with a decent gross margin. With positive operational cash flow, the company is positioned to do well in the future. In my opinion, there are two big questions for shareholders. Will the aggressive capex investments pay off? If so, Dutch Bros represents a tremendous opportunity. However, if the value of those investments do not pay off in operational cash flow, then the company is digging itself into a very capital-heavy hole. The second question is related to the first in that in order to continue to finance its growing capex, Dutch Bros will likely need to dilute shareholders again. If management can thread the needle regarding growth, capex, and shareholder dilution, This company will be a tremendous asset to an investor's portfolio. If one or more of those factors falter, then shareholders could be in for a bumpy ride. For now, I am hopeful. This company is going on the watch list. Many thanks for watching. What do you think about Dutch Bros and their aggressive capex investment? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.